How's it going, everyone? Matt Leighton, welcome back to another video. In this video, we talk about how I need to buy sunglasses. No, I'm just kidding. In this video, we talk about the tax assessment and why that might be different than the sales price. I'm here in Penrose in Arlington, Virginia. Cool little patio, a little outdoor area in the summer. In the warmer months, it is very popular. It's actually 60 degrees in December, so pretty warm right now. But let's get into the tax assessment. First of all, what is the tax assessment? The assessed value is used for tax purposes. The assessor actually doesn't go into your house. He or she doesn't go into comparable properties. They don't actually see the interiors. They simply have their own method of calculating the value with number of bedrooms, bathrooms, square feet. It's more complex than that, but they use an outsider kind of third-party approach to determine how much the property should be taxed. If other homes in the neighborhood have sold recently or other homes in your condo building have sold recently, those will definitely factor in. The thing is, the assessment is only done once a year, at least in Arlington County. It's only done once a year, so that assessment is usually always trying to catch up and chase the current market value and that current sales price. So at least in Arlington, the assessments are always below the sales price. Now, the assessment is determined by the county. For instance, in 2017, Arlington County, the tax rate decreased, which rarely happens, but it came around full circle and the overall assessment value increased. So you have the rate at which the property is taxed, and then you have the overall property assessment. Two different things that determine the total tax assessed value. Now that we know what the tax assessment is and how it's calculated, let's compare that to the sales price. Because you're an informed buyer, you're gonna look at the tax records of the properties that you're gonna be writing an offer on. You might see one tax assessed at $350, and then it's gonna be listed for $400,000. Now, why in the world would you pay over $50,000 for the list price when it's only assessed at $350? Well, keep in mind that the assessment has literally nothing to do with the sales price or even the market value for that condo or for that property. Improvements to the property and even current market conditions are not factored in. Occasionally, you may get an assessor that comes around and knocks on your door and asks to do an assessment, but this is an extremely rare situation that you probably won't ever find. Now, I do think that there's one way that you can look at the tax assessment and compare that to the sales price and use that to your benefit when you're looking at properties for sale. And that is if there are two condos or two very similar properties that come on at the same time, you pull up both of those tax records and compare the tax records to the sales price. Now, if one is tax assessed higher than the other, then the correlating sales price should also be higher. If there's any discrepancies, if the higher tax assessed one is actually lower priced, you might have a steal. But on the other hand, if one is taxed lower than the other but is actually priced higher, there might be a discrepancy where that one is actually overpriced. That all being said, you should not use the tax assessment to determine the sales price or even the market value of the property. It's almost irrelevant. The only people that determine the sales price and the market value of the home are the buyer and the bank. Sure, the listing agent and the seller set that listing price, but that's kind of just a marketing tool to sell the home. The only two people that factor into the sales price and market conditions are the buyer, the person actually paying that market value, and then the bank, the person that's actually financing that and that's appraising that value. The assessment, guys, it's just a distraction. It goes on in the background here in Arlington County. The assessment is almost always below the sales price. And then if you go down to the city of Alexandria, the assessment is almost always higher than the sales price. So we can't really use that assessment and sales price as a whole to determine the market value of a property. Instead, look at what comparable homes have sold. Look at the recent solds in the building or in the community. Look at the market. Don't look at the assessment. Remember, the assessment happens once a year. The market value is always changing, and that's most recent. Now, to summarize, why is the assessment different from the sales price? Well, first, it only happens once a year. The assessment only once a year, so it's behind. Second, the assessor doesn't even go into your house. They don't know about that granite countertop. They don't know about the improvements. And third, one thing I didn't even mention is that the assessment just might be flat out wrong. It just might have the incorrect number of bedrooms or incorrect number of bathrooms listed. It just could be incorrect. Now, if you don't like your assessment or if you think your assessment is too high, don't complain to your friends and do nothing about it. You can actually file a formal complaint or maybe a formal argument where you present your case, you have your list of comps, and your assessment can actually go down if you present your argument well enough and if the county or your city, your jurisdiction buys what you're selling. All right, so thanks for watching this video on tax assessment and why that's different than the sales price. Hopefully that sheds some light on why the sales price is usually always higher depending on the jurisdiction than the tax assessment. If you have any other questions on tax assessment versus sales price, be sure to drop them in the comment section below and I'll check that out. Okay, thanks for watching. Until next time, create a productive day. Take care.